Well, hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to my weekly show here on Stockcharts TV. It's great to be back with you, and I hope you guys are all doing well. As we're now in the month of October, we're now getting into Q4 of 2025. Now, the third quarter of 2025, remarkably stronger than expected, I would say, for many of us, particularly the month of September, right? I would say many of us were looking for, or certainly looking at the normal seasonal tendencies, which suggests a pretty weak September. Most years, September has actually been a down month, a month when the bull phase from the summer starts to lighten up. We didn't get that in 2025. We've had this AI-fueled euphoric rise in risk assets continuing here into early October. The question for many is, when will that bullish run for stocks start to exhaust? Today, though, we're not going to talk about stocks. We're not going to talk about risk assets. We're actually going to talk about what is often considered one of the least risky assets, an incredible store of value, and an area and an asset class that investors have been thinking about for centuries: gold. We're going to talk about the yellow, the glistening yellow metal, as it were. So today we're going to talk about gold. We're going to look at the historical context of this incredible rise in 2025, because you probably know by now, but if you've been hiding somewhere in your equity world and have been ignoring the commodity markets, you may have missed the fact that gold has actually outperformed the S&P and the NASDAQ in 2025, despite the fact that equities have been in a primary bull market for most of that year. So year to date, gold has done remarkably well and better than the equity indexes. Now, off of the equity April market low, you will actually see that gold has underperformed the S&P and the NASDAQ. But gold stocks like Newmont Mining, like Anglo Gold, like Kinross, like all those other gold stocks you may have heard of, that group of stocks has actually performed better than the S&P and the NASDAQ off of the April market low. So we'll look at some historical context. We'll talk about the recent uptrend, the extended move that we're seeing right now in gold, as a lot of gold stocks and gold-related ETFs are very much in the overbought region here in early October. We'll put on our trend-following hat, give you some ideas about how to maybe track this uptrend, how to manage risk in an area of the market that has been remarkably strong. Before we get to a lot of great charts of gold and insights for you using the Stockcharts platform, I do want to let you know, if you're looking for a market recap show, it's awesome. It's called Chart This with Dave Keller, and it's on my YouTube channel called Market Misbehavior with Dave Keller. So check me out over there. You can follow the live stream every weekday after the close at 5 p.m., where we do a brief recap of the market activity for the day. We look at the heat map called the Market Carpet on Stockcharts, focus on stocks and groups and themes that are on the move that you should know about. And then we finish looking at a bunch of individual charts and apply the best practices of technical analysis. We're also taking questions at all times. So if you tune into the live stream, you can ask questions as we go. We always take a question or two at the end of the episode. So make sure you tune into our market recap show. And again, that's on my YouTube channel. We also have a Market Misbehavior podcast, which has had some fantastic guests in 2025. Everyone from Bob Pisani, sort of legendary market reporters and journalists, to money managers like George Noble, to authors, educators, and everyone in between. So please tune in. We've got some great guests lined up here in October. Most recently, I actually interviewed Mary Ellen McGonigal and Frank Capillari, two fellow Stockcharts contributors, with some really awesome takeaways about the current market environment, good tips and tricks about how to use the Stockcharts platform that you'll uncover from those interviews. So please make sure you check that out on my YouTube channel as well, also on all the podcasting platforms. All right, let's look at some gold charts here. We're going to start drawing on the great historical database that is available to Stockcharts members called their Historical Chart Gallery. I'll show you how to get here in a minute, but we're going to start looking at the long-term chart of gold going back to the late 1960s. So if you take a big step back from your monitor, you'll find that this latest upsurge in gold prices is actually part of a much larger story about the great improvement in gold. And, as I was learning about investing, as I was just getting started in the industry here in 2000, we had the equity markets, ripping to the upside in the late 90s, right? And that's when I was in the industry, when I was just starting. It it was all about the tech bubble and an open question as to whether it was a bubble, right? Which reminds me way too much about what I'm hearing here in 2025 about AI stocks, but that's probably the topic of another video. You can see that in the late 90s, gold was actually in a primary downtrend. The all-time high in gold was back here around $650 an ounce. Back in 1980. And so, gold had come down aggressively, right? Quite a bit from that point. So the general assumption was when gold is doing well, stocks are not doing well, and sort of the opposite, right? Gold's a safe haven. And that sort of idea really flourished here as I was getting started. And this is, to this day, a sort of bias that I have to fight, the idea that gold goes up when stocks go down. But you'll notice that gold actually went up pretty consistently from the early 2000s all the way to the 2010s with a peak here around $1,800 an ounce. And that happened in 2011. So during the bear market, basically the secular bear market, from 2000, we'll call it to 2012 or 2013, depending on when you consider that secular bear market ending, gold was actually going up during that entire time. So as stocks were struggling in 2001 and 2002, gold was rising. As stocks were in a primary uptrend in 2004 and 2005, gold was going up. It went up all the way into the 2010s. In my Fidelity days, most of that time, gold was actually once again in a sort of cyclical downtrend. And from 2011 down to a low around 1050 in late 2015, gold was actually in a significant downtrend. Big rally in the late teens, consolidation in 2021, 2002, 2023, kind of the post-COVID era. But in 2024 and 2025, gold has been accelerating. Now, by the way, the Stockcharts platform for members actually features some fantastic deep history, and I would encourage you to explore what they call the historical chart gallery. If you're not familiar with this, I say untapped or underutilized resource on the Stockcharts platform, here's what you do. Go to the Stockcharts website, click on Charts and Tools. In the upper left corner, you're going to find this selection called Historical Chart Gallery. It's all by category, so you can find different presidential charts, actually thinking about how the market has performed during different presidential administrations. I would argue there's a lot of politicking where people sort of brag about market returns during different administrations. This is where you can actually, look at the raw data. Deep history of breadth indicators, of fundamental data like earnings and valuations. We're going to look at the key market indexes. It's by asset class. Click on commodities, you'll get this chart of gold. There's silver, other commodities, and a lot of other great charts to reflect on. So I would encourage you to dig into their charts. I was taught are the ultimate history lesson, right? If you want to understand what the markets have done during historical periods, you got to start with the charts. All right, so let's look a little more recently. This is looking at the last 2 years, and we can see how this uptrend in 2024 and 2025 has really played out. I mean, it's remarkable how consistent this uptrend has been. Now, I will tell you, even though the longer term, right, if you take a step back, you can see that the price has just been in a primary uptrend essentially this entire time. Higher highs, higher lows. Certainly the weekly chart reflects that. The 200-day moving average, which is in purple here, has been sloping upwards the entirety of the last 2 years. The 50-day moving average, you can see a couple times where the 50-day has gone flat, if not slightly lower. And that highlights some of these short-term really pauses in the trend. I mean, there have been pullbacks, but they haven't been that significant. But we saw a brief corrective period here in the spring of 2024, another one in the fourth quarter of 2024, and then more recently from the April equity market low into the end of August, gold was actually sideways, and that's where the outperformance of the S&P and the NASDAQ really came to be, right? I mean, gold was outperforming, going up all through the first quarter. So going up while stocks were rallying in Q1, but also kept going higher in March and April as a lot of funds flowed into gold as a sort of a safe haven against the destructive move in stocks. From that April market low, you can see basically through the end of August, gold basically held its values stable around $3,200 to $3,400 an ounce generally, while the S&P and the NASDAQ just minted these incredible returns during those months. So that's where the outperformance really came. Now, from the end of August through September and now to early October, that's where we're seeing once again a resurgence in the price of gold. By the way, this is why I often scan for charts making new 3-month highs. It's to capture this particular type of move. When anything, a stock, an ETF has had a good run, then it kind of gets a consolidation phase, right? As we've talked about many times on my show here, I think of markets as going in any one of 3 directions at a given time: going up, going down, going sideways. And in this case, we have a sideways trend, a consolidation phase, where the highs and the lows are fairly stable. We're basically at an equilibrium. The market's saying gold's worth about $3,300, $3,400 an ounce, and we're just kind of fluctuating naturally or rhythmically around that equilibrium price. So what you look for in that environment is for a new, new information, right? A new resurgence, a move, a breakout, either above the upper end of that range or below the lower end of that range. Of course, if we break below the lower end, that's where it tells you we're in a new distribution phase. We probably want to get out of the way. In this case, we saw the opposite. We saw a new accumulation phase as gold surged higher at the end of August. Finally, at the beginning of September, broke above $3,500 an ounce for the first time. That was a fantastic signal that a new bullish phase, a new accumulation phase was happening. And you can see, looking left on the chart, a number of times where that sort of pattern has happened. And just looking for that break to a new 3-month high is often a really good signal. Something good, it's not over. Something good is really starting to emerge. We're going to come back to the overbought conditions, but note the fact that the RSI is currently above 80. It's up to around 84. We can see other times when gold has been overbought. That's often been kind of earlier on in the rally, which is why I would say it's very encouraging that gold became overbought in early September. What you look for is gold no longer being overbought for now, at least as of Tuesday, October 7th. The upturn's in pretty good shape. We're going to look at the GLD, right? There are a number of ways to play gold. Most people don't really play in the futures market, at least equity investors and ETF investors that I work with. Plenty of people trade futures and trade gold futures directly, but I found for a lot of investors that are more equity-oriented, the rise in gold ETFs has provided great opportunity for investors to play gold stocks, certainly, but even physical gold. And there are a couple ETFs, GLD and IAU in particular, that stand out because they literally are holding physical gold. So it's a pretty good way of tracking gold prices. So I look at $gold, which is the spot gold price, but more often than not, I actually look at the GLD because most people, can get access to the value in gold. If investors that I work with, either individual investors or financial advisors, they're usually using an ETF like GLD to actually play gold or to incorporate gold as part of an asset allocation strategy. So I think it's a pretty good way of thinking about it. So I've added some notations on here, some artwork on the chart. Let's talk through what we're showing here. So first off, let's go bottom to top. And as you look at the bottom panel, we have the RSI, or the Relative Strength Index. And I mentioned that gold is currently overbought. And actually, I would say extremely overbought with an RSI above 80. And again, we'll come back to that in a moment. But what I've done is I've shaded the last 2 years, or actually the last 3 years of the GLD, and just shaded when the RSI is in the bullish range or the bearish range. This is a technique I use often, call this like the RSI range rules or something like that. I probably should develop a really catchy name that I can start trademarking or something, but the range rules make sense. But basically, this is a concept drawn from work by Connie Brown and Andy Cardwell. They were two technical analysts over time that have added a great amount, I think, to the technical toolkit and body of knowledge about how to use indicators like RSI. And the concept of range rules is basically you don't think of RSI as having a static range, right? We are taught, if you read books about technical analysis, and you can see the solid lines here at the 30 level and the 70 level, the idea is there are static levels where a stock or an ETF becomes overbought and oversold. Above 70 is overbought, below 30 is oversold. And generally, as a rule of thumb, I don't think that's a bad thing. But in reality, what happens is the range in the RSI tends to fluctuate. And in a bull market phase, like you see from Q3 of 2023 through Q4 of 2024, we can see that the RSI was generally in the bullish range, right? So the RSI often became overbought on rallies and would rarely get below 40 on pullbacks. So the whole range of the RSI has kind of moved up. In distribution phases, like in mid-2023, you can see the entire range of the RSI drifts lower. So the RSI gets oversold on those downswings and then rarely gets above 60 on bounces higher. So when the whole range of the RSI goes down, kind of confirms that we're in a bearish range. So we can see that the range of the RSI has actually been pretty constructive for almost the entirety of 2025, right? Q4 of last year, we were actually had just experienced a brief pullback and a consolidation phase. And then once that uptrend resumed, the RSI pushed above 60, and it's been pretty consistently in that bullish range. Now, I would point out a couple other things, continuing here at the bottom. I mentioned earlier, when the RSI is overbought, it's not necessarily a bad thing. That is one of the things I hope is one of my legacies as a technical analyst, and educating people about how to use these fantastic tools and techniques to help people understand that an overbought condition is not a bad thing, right? By definition, it's actually a very good thing, because it means that the price of whatever you're looking at is going up. So overbought means up a lot. It means it's been going up. It means that the underlying asset has been in an uptrend, and that's kind of a good thing. So what we want to be concerned about is when the RSI is no longer going up, right? When we have those divergences, when we have less momentum supporting an uptrend. At this point, the momentum in gold is quite strong with the RSI pushing above 80. But notice the pattern that we're seeing on the top here, and you can see that when we break out and when we have the beginning of a pretty significant run higher, we often become overbought, and actually, especially in early 2024, became extremely overbought with the RSI over 80. That's actually, we used to call that the good overbought, right? If the RSI gets all the way up to 80, that usually implies we're going to have at least one more big move higher, because the upside momentum is so significant. So note that when we initially become overbought, after a while of not being overbought, that actually leads to pretty consistent returns. Actually a pretty good thing when the RSI gets up into that range. Again, if the price would keep going higher on weaker momentum, right? If we would have a bearish divergence, that would be a big red flag. I'm not seeing that red flag right about now. Now, I've also highlighted a couple particular points here that I want to share with you. If you look at April, May, June, July of 2024, we became overbought. We moved to a new swing high. We had a pullback around 6.5% during that period. We retested the high. Then we briefly went below the 50-day moving average. Recovering above the 50-day moving average, improving momentum suggested that the uptrend was resuming. Then again, in October, November, December, January, here at the end of 2024, we saw an 8.4% pullback from the October peak to the low in mid-November. We then again pulled below the 50-day moving average. We recovered, made a new swing high, momentum improved. That was the new uptrend. Most recently, we've had the exact same pattern, almost identical pullback to what we saw in the fourth quarter of last year. We saw about an 8.3% pullback in April into a May low. We then retested the high a number of times, pulled below the 50-day moving average, finally surged higher on improving momentum. So what that tells me is there's a pretty consistent, repeatable pattern here over the last couple of years where gold has been in a primary uptrend. We've had 3 different times where we violated the 50-day moving average because the momentum has recovered, because we've gone back above the 50-day moving average after that initial drawdown and seen improved momentum. That's given me confidence that the uptrend would continue. So something to keep in mind if we do eventually get to an exhaustion point, which I'm sure we will at some point. I would be looking at this historical playbook. Pullbacks in the 6 to 9% range have been pretty common here over the last couple of years. Looking for a break below the 50-day moving average, as long as it doesn't go much further. And when we finally get a recovery in momentum and a breakout in price action, it's led to pretty significant gains. That's sort of a playbook I would think about going forward. Now, while gold has done quite well, and certainly in a primary uptrend, gold stocks, even better. Here's a chart that actually tells that story. This is the GDX, which is the VanEck Gold Miners ETF. There are a number of different gold stock or gold miner ETFs that you can track, but this is one that I wanted to highlight for you. Similar to the price of gold, gold stocks actually surged higher at the beginning of August. We can see we broke above $54, $55 a share on the GDX. Again, that was the beginning of a pretty good run higher. Now we have the moving averages in the proper order, meaning for me, the price above the 21-day EMA, the 21-day EMA above the 50-day, the 50-day above the 200-day. They're all sloping higher. This is a pretty good uptrend. But check out the ratio on the bottom. This is the ratio of gold stocks to physical gold, right? The GDX, which is gold miners, to GLD, which is physical gold. So Gold stocks have actually been outperforming physical gold pretty consistently in 2025, but especially in August and September. Let's look at that performance in a little bit more detail. Here's year-to-date 2025. We can see that the S&P 500, starting at the bottom, is up about 15% for the year. Physical gold up about 51% for the year. Physical silver, this is the SLV ETF, up about 65%. Here's gold stocks up about 128% year to date. So there's a huge performance gap between the S&P 500 and gold stocks. Now, obviously, gold has floundered a bit in the spring into the summer. Did flounder a bit, while risk assets like equities were surging higher. So let's start at the April market low. And you can see that the GLD, while it's catching up to the S&P, is underperforming the S&P just slightly, up about 33% off of that April 8th low. The S&P is up about 36% during that period. But here's physical silver up about 60%. Here's gold stocks up about 86%. So no matter how you slice it, gold stocks have actually done better than the S&P 500, than the Nasdaq during these periods. Now, let's talk a little bit more about what's happening on the charts now. Here's the chart of Newmont Mining. Now, in the S&P 500, there are very few gold stocks. In fact, there's only one, NEM, which is the largest of the gold miners. It's about a 96 billion market cap, getting very close to 100 billion market cap here as the price has rallied pretty significantly. We can see on the chart what I would consider a pretty classic cup and handle pattern. That's where you have a big run higher, you have this rounded bottoming pattern, a retest of that initial high, another pullback, and then finally a break above what we call the rim of the cup. That cup and handle pattern suggests much further upside, and certainly since June and July, we've had a beautifully consistent uptrend phase. We can see at the very bottom, Newmont has been outperforming the S&P 500, certainly in the last quarter. We can see the RSI has been in the bullish range pretty consistently since January of 2025. And as we've seen with other charts, we have the moving averages in the proper order. So what do you do with a chart like Newmont Mining that's been in an uptrend? I actually did a webcast last month called Trend Following 101, where we talked all about some trend following tools, talked about the 3 goals of trend following: to identify trends, to follow those trends as long as possible, and then to recognize when the trends are shifting. And I would say for Newmont Mining, I think we are definitely in that second goal. We're doing that, which is following the uptrend. We have confirmed a breakout. We have confirmed stronger momentum and stronger relative strength. Our goal now should be to follow that trend as long as possible. We should also be anticipating and certainly recognizing when that trend would shift. So what we'd be looking for, this is where I think the trend following toolkit is just fantastic. We can talk about upside projections for Newmont Mining. I could tell you, here's the target that someone has for Newmont Mining down the road. By the way, Goldman Sachs just came out and said they had an upside target of like $4,600 an ounce for physical gold, which is currently well above the current levels, by the way. So, what does that mean for stocks like Newmont Mining that have a run? I would argue the goal should be follow this trend as long as possible. The great thing about the technical analysis toolkit, it is filled with what are called lagging indicators to help you follow a trend, limit your losses, lock in your gains, just sort of follow the uptrend as long as possible. True trend following indicators or momentum indicators, you look for signs that trend is reversing. For me, two things I would be looking for. Number one, I would be looking for a break of the 21-day exponential moving average. It's not a perfect stop loss. It's not the only thing I would ever use, but particularly with a chart like this that has been working for so long, particularly with a consistent uptrend that has had very few issues, until it breaks the 21-day exponential moving average, things are fine. They're just good, right? They're just fine, right? And so for me, having something like the 21-day exponential moving average allows me to not worry about the chart of Newmont Mining. I no longer have to check this chart a couple times a day to make sure it's still going up. I just wait to see if it breaks the 21-day EMA. And if it does, then I'll revisit a position. I don't have a position in the NEM right now, but if I did, that's what I would be doing. So number one, look for any break of the 21-day EMA. Now, how could we anticipate potentially a break is going to happen? Well, as we've mentioned with a couple of the charts here, this is where the indicator called RSI can be so helpful. When the price is going higher on strong momentum, right? When we're making new highs in overbought conditions, that's good. If we would make a new high on weaker momentum, if the price would keep going up, but the RSI would slope lower, if we would have a new high with the RSI not becoming overbought. That would be a major league red flag called a bearish momentum divergence. But as we can see from the chart, we're not seeing it today. So that's how I'm thinking about the gold space. We're in a primary uptrend. Our market trend model applied to the chart of gold is bullish on all time frames, and we can see that's part of a much larger historical uptrend that we've experienced here in the sparkling yellow metal. We talked about gold, physical gold versus gold stocks. We talked about the GLD and IAU as sort of representatives of gold and gold futures. How that uptrend has been remarkable, how the momentum using the RSI, we could talk about the RSI ranges and think about how the bullish phase has been marked by the RSI consistently in that bullish range of values. We also talked about gold stocks versus physical gold, the year to date and the performance off the April lows and how that relates to our major equity indexes like the S&P and the NASDAQ. Finally, Trend Following 101. A trend is your friend until it ends. So keep following these uptrends. Use the tools and techniques available on the Stockcharts platform to make sure that you limit your risk and you follow those gains as long as possible. That's why we use lagging indicators like the 21-day EMA. I've got a great video that I did recently on the 21-day exponential moving average. If you want to learn more about that, check out the link in the description. I'll give you some further insights on how to use that fantastic trend following indicator. If you're looking for my market recap show called Chart This with Dave Keller, we're back live better than ever here on October 7th and for hopefully many, many trading days going forward. You can find that as well as my Market Misbehavior podcast on my YouTube channel called Market Misbehavior with Dave Keller. That'll do it for this week. Have a fantastic week and enjoy it. And we'll be back with you again next week with another episode here on Stockcharts TV. In the meantime, I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.